Welcome to the new episode of Inside the Economist's Mind. Today we're taking a deep dive into the latest signals coming from the Australian housing finance market, all based on the Australian Dwelling Finance Bulletin that dropped on May 14th, 2025. For you, our listener, the learner, the goal here is really to get a quick but thorough understanding of what's happening, to see these trends from different angles, maybe have those aha moments without feeling like you're drowning in data. So our mission in this deep dive is to unpack the key movements in new lending and what they might be telling us about the future of Australian property. We'll be looking at how much money is being borrowed, how many loans are getting approved, the split between owner-occupiers and investors, and of course what's going on across the different states. Okay, so let's start by looking at the big picture. It seems new lending has hit a bit of a speed bump.
That's a key observation right off the bat. Yeah. The report points to a 1.6% drop in the total value of new home loan approvals. That's in the first 3 months of 2025.
Yeah, 1.6%.
And what's really notable is that this is the first, siggnifant dip we've seen in 2 years. It suggests the strong upward trend we've been tracking might be, losing steam.
Right. 2 years is a long time in this market.
Exactly. And if we look at the year-on-year figures, we're still seeing growth, 14.2%, but that pace has definitely slowed from where it was. Projections suggest it could even fall to single digits next quarter.
Wow. Okay. And it's not just the amount of money being borrowed, is it? The actual number of people getting new loans has also dropped.
Precisely. The report shows a 3.5% decrease in the number of new loans approved in that same first quarter.
3.5%.
Yep. This dip in volume is a strong indicator that overall demand in the housing finance market is indeed cooling. But there's a really interesting nuance when you compare the value and the number of loans.
Okay. Lay it on me. What's the twist?
Well, okay, so despite fewer loans being approved, the total value of those loans still grew at a faster annual rate. Yeah, 14.2% annual growth in value compared to just 6% growth in the number of loans. What this strongly suggests is that the average size of the loans being taken out has increased, significantly actually. It contributed over 8 percentage points to that annual growth in value.
So fewer people getting loans, but those who are borrowing more money on average.
Exactly that.
That's fascinating. It really makes you wonder who these borrowers are, doesn't it? And what's driving them to take out larger loans, even as the overall market seems to be, softening. Is it a particular segment that's still very active, perhaps?
That's precisely the question this data raises. Now, if we drill down a bit into who's leading the slowdown, the report highlights a pretty significant pullback from owner-occupier.
Well, owner-occupiers, right? The bread and butter of the housing market, you could say. What's the story there?
We're seeing a 2.5% quarterly decrease in the value of loans to owner-occupiers.
Okay.
And even more pronounced, a 3.4% drop in the number of loans.
Right, so fewer owner-occupiers getting finance.
And within this sector, loans related to construction have taken a particularly sharp hit. They fell by 4.5% in value.
Construction? That's interesting.
Yeah, this downturn in construction finance could have, broader implications for the supply of new housing down the line.
Construction loans are often seen as a leading indicator, aren't they? A drop there might suggest developers, and maybe buyers too, are getting a bit more cautious about new projects.
Absolutely. And the report specifically points out that loans for purchasing newly built homes, including those bought off the plan,
Yeah.
they experienced a substantial 7.8% quarterly fall.
Wow, nearly 8%.
Yeah. This could be reflecting concerns about maybe rising construction costs or potential delays, or perhaps just a shift in buyer preference towards established dwellings. It certainly raises questions about the robustness of the new construction market going forward.
And, like you always say, the national picture doesn't tell the whole story. What are we seeing at the state level for these owner-occupier loans?
Yeah.
Any big differences?
It's quite a mixed bag, actually. While nationally we see this decline, South Australia and New South Wales actually saw an increase in the number of owner-occupier loans approved.
An increase. Okay.
Yeah, SA was up 1.9%, NSW up 1.5%. Queensland remained pretty flat, zero change. But Victoria experienced a more noticeable decrease.
So really highlights how local conditions matter.
Definitely. It underscores how local economic conditions, buyer sentiment, it can all vary significantly from state to state.
Okay, so some states holding up better than others for owner-occupiers. What about investors? Are they following a similar pattern of decline?
Investors are showing, let's say, a more moderate weakening compared to owner-occupiers. The total value of investor loans decreased by just 0.3% in the first quarter.
Just 0.3%, so much smaller dip.
Much smaller. Although it's worth noting that this follows a 2.5% decrease in the previous quarter.
Ah, right. So it's maybe a trend developing.
It indicates a gradual cooling in investor activity, yeah. Not a sharp drop, but definitely a slowdown.
And how does that break down across the states for investors? Similar variations.
Interestingly, yeah. New South Wales and Western Australia showed a decline in investor loan activity during that first quarter. But the annual growth rate for investor loans remained above 10% in all states except the ACT.
Still double digits, mostly.
Mostly, yes. Which suggests that while there might be some softening in certain markets, overall investor demand generally remains, well, relatively robust. Still, there are those regional variations.
Okay. It really does sound like the housing market's strong upward momentum, the surge we saw, has slowed considerably. The report uses phrases like, the housing upturn has lost considerable momentum. That sounds quite definite.
It's a very accurate summary, I think. The report highlights that after a period of strong growth, the market has definitely shifted gears in early 2025. While the Reserve Bank's February interest rate cut did provide a bit of a boost.
Right, there was some response to that.
There was, particularly in Sydney and Melbourne, but overall market activity, turnover, it just hasn't regained its previous pace. It's been soft.
And you mentioned those middle-sized capital cities, Brisbane, Adelaide, and Perth, which were really strong performers for a while. They're seeing a change too.
Yes, exactly. The fact that price growth is moderating in those cities is a significant development. They were key drivers of the market's strength, so a slowdown there indicates a broader cooling trend across different geographical areas.
Right.
And furthermore, as we discussed, that dip in construction-related lending, it suggests that the recent increase we saw in approvals for new dwellings might not actually translate into a sustained pipeline of new properties.
So the approvals might have ticked up, but the finance isn't necessarily following through at the same rate.
Precisely. The overall feeling from the report is that the housing sector is kind of in a period of uncertainty. It lacks a clear direction for the immediate future.
Okay, so it's not just the lending data itself that's pointing to the slowdown, is it?
Yeah.
You mentioned other market indicators aligning with this picture.
Exactly right. Auction clearance rates, for instance. They give us a sense of buyer heat,
Yeah, how many properties sell into the hammer?
Well, they've declined from about 64% in February down to under 58% in May.
Noticeable drop.
It suggests buyer demand at auctions is softening. And alongside that, the annual growth in dwelling prices has also been moderating. It fell from 4.8% year-on-year growth in February down to just 2.2% in May.
Okay, so less than half the annual growth rate just a few months later.
Yep. These are all consistent signals. They're pointing towards a cooling housing market.
Okay, so we've got declining lending, particularly for owner-occupiers and new construction, softer price growth, lower auction clearance rates. What does this all suggest when we step back and look at the broader Australian economy? What are the potential impacts?
Well, these trends in housing finance approvals can have several knock-on effects for the wider economy. The housing market is just such a significant component of our economic activity.
It touches so many areas.
It really does. A slowdown can impact consumer confidence, for one. Housing wealth is a key factor for many households, so if prices cool, people might feel less wealthy and spend less. It also directly affects the construction industry. Less finance for new builds could lead to a decrease in investment and potentially employment in that sector.
Right, fewer jobs on site.
And for first-home buyers, well, a cooling market might offer some relief in terms of less competition, maybe more accessible prices, but tighter lending conditions could still present challenges for them getting approved.
So maybe easier to find a place, but harder to get the loan.
Could be, yeah. And investors might become more cautious too, which could influence rental supply and their investment decisions down the track. Overall, the slowing momentum in the housing market, it raises important questions about the future pace of broader economic growth.
Okay, so to try and bring this all together for you, our listener, this deep dive into the latest housing finance data, it really paints a clear picture of a slowdown, a definite cooling in new lending approvals across Australia. This decrease seems to be primarily driven by owner-occupiers, especially in that construction sector, though investor activity is also moderating, particularly in states like NSW and WA. And those varying state-level figures, combined with the softening of other market indicators like clearance rates and price growth, it really suggests a housing market that has, well, lost considerable steam.
And here's where it gets really interesting to think about, as we touched on earlier, that fact that average loan sizes are going up even as fewer loans are being approved.
Yeah, that's the real puzzle piece.
It points to a potential shift in who is actively participating in the market right now. Could we be seeing perhaps a segment of more financially secure buyers still active, maybe looking at higher value properties, while other segments, like maybe first-time buyers or those seeking smaller loans, are becoming more hesitant or perhaps facing greater barriers to entry?
It certainly suggests the market isn't cooling uniformly for everyone.
Not at all.
So as you're trying to understand the broader Australian economy, it's clear the housing market is a really crucial piece of the puzzle. This latest data suggests a period of, well, uncertainty and potentially cooling activity ahead. It definitely makes us wonder what factors might turn this trend around, or maybe even cause it to accelerate in the coming months.
And finally, here's something to really think about, a provocative thought for you perhaps. Given how closely the housing market is linked to things like consumer confidence and overall economic activity, what might be the wider consequences, the flow-on effects of this slowdown in home lending in the months ahead? And crucially, what other economic indicators should we all be paying close attention to now? Things like job figures, retail spending, inflation rates. What will give us a more comprehensive picture of where the Australian economy is actually heading?